Could the revival of brick-and-mortar retail be the next big trend in commercial real estate? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a surprising turn of events, the post-pandemic retail real estate market is experiencing a significant transformation. While e-commerce continues to capture much of the spotlight, brick-and-mortar retail is far from becoming obsolete. Instead, it's evolving, adapting to new consumer behaviors and leveraging technology to secure its place as a key component of omnichannel strategies. According to Market Pulse, a new wave of investment in physical retail assets is underway, driven by undervalued properties and strategic repositioning. A prime example of this trend is Onyx Partners' recent acquisition of 119 JC Penney stores for a staggering $947 million. The retail real estate landscape in 2025 is marked by resilience and repositioning. Occupancy rates for neighborhood and community centers have hit historic lows, with a mere 4.7% vacancy rate, indicating strong demand and limited supply. This is partly attributed to the repurposing of legacy retail spaces, which were left vacant by bankruptcies like those of Party City and Big Lots, into smaller, more dynamic formats. Retailers such as TJX Companies, which includes Marshalls and Home Goods, along with Hobby Lobby, have thrived in this environment, proving that physical locations remain crucial for engaging consumers. Consumer behavior has shifted significantly, with the pandemic accelerating a preference for convenience, sustainability, and experiential retail. Stores are now expected to serve multiple roles, such as distribution hubs for online orders, showrooms for digital brands, or destinations for immersive experiences. The average retail store footprint is projected to shrink by 20% in 2025, while investments in technology and experiential elements are expected to double. Onyx Partners' acquisition of the JC Penney stores is a textbook example of identifying and capitalizing on undervalued assets. The portfolio spans 15.86 million square feet across 34 states and is fully leased under triple net agreements, meaning JC Penney is responsible for all operating costs. This structure provides Onyx with a stable, predictable income stream of $100 million in first-year net revenue while minimizing operational risks. Notably, the cap rate of 10.4% is particularly enticing in a market where yields for stabilized retail assets have typically ranged between 6% and 8%. The deal also highlights the broader appeal of repositioned retail assets. Following JC Penney's bankruptcy in 2020, its real estate portfolio was placed in a trust and systematically liquidated. Onyx's acquisition is the largest single transaction in this process, showcasing investor confidence in stabilized retail assets with national credit tenants. The portfolio's geographic diversity, spread across Sunbelt markets like Phoenix, Dallas, and Atlanta, further enhances its appeal, as these regions are anticipated to experience the strongest rent growth over the next 5 years. The timing of Onyx's acquisition is no coincidence. 3 macroeconomic factors are converging to make retail real estate an attractive investment: low vacancies and tight supply, evolving retail formats, and capital market optimism. Neighborhood and community center vacancies are near record lows due to constrained new construction and the repurposing of older retail stock. Asking rents are rising at the fastest rate in 15 years, with projections of 3.1% annual growth through 2030. Retail formats are evolving, with a rise in smaller footprint stores, drive-through capabilities, and experiential retail creating demand for flexible spaces. Properties that can adapt to these formats, such as JCPenney's large format stores, are prime candidates for repositioning. Meanwhile, institutional investors are increasingly viewing retail real estate as a core asset class. Commercial mortgage-backed securities issuance rebounded to $108 billion in 2024, and lenders are favoring grocery-anchored and service-driven retail over traditional malls. Onyx's acquisition isn't just about generating income, it's about creating long-term value. Although specific repositioning plans haven't been disclosed, the portfolio's large format stores in suburban locations make them ideal for mixed-use development. For instance, Converting a JCPenney site into a retail residential complex or adding wellness and food service components could unlock additional value. This aligns with broader industry trends, as Deloitte's 2025 Commercial Real Estate Outlook emphasizes the importance of adaptive reuse and sustainability. Retailers and investors are prioritizing properties that can integrate green technologies, meet building performance standards, and serve multiple functions. In fact, 76% of global real estate investors plan to undertake deep energy retrofits in the next 18 months, a trend that could further enhance the appeal of repositioned retail assets. For investors, the JCPenney deal underscores the importance of looking beyond traditional metrics. While e-commerce continues to reshape retail, physical locations remain indispensable for customer acquisition, brand loyalty, and last-mile logistics. The key is to focus on assets that can adapt to these changes. Prime locations in Sunbelt markets with strong population and income growth, such as Phoenix and Nashville, are ideal. Flexible leases, particularly triple net or net lease properties with credit tenants, offer stability and high yields. Additionally, assets with large footprints or suburban sites can be redeveloped into mixed-use or experiential formats. The post-pandemic recovery is not about returning to the past, but pivoting to a new paradigm. For investors willing to embrace this shift, retail real estate offers a compelling combination of income, capital appreciation, and strategic flexibility. Onyx Partners' acquisition of JCPenney stores serves as a testament to the sector's resilience and a signal that the best days for brick-and-mortar retail may still lie ahead. Brimor Property Group has made a notable acquisition, purchasing La Cantera at Cinco Ranch for $223 million. This acquisition is part of Brimor's strategic plan to enhance its presence in key markets and diversify its tenant base. The group aims to bolster its retailer relationships and adapt the merchandise mix across its portfolio to meet evolving market demands. This move by Brimor Property Group underscores the ongoing trend of investing in retail spaces that offer a blend of retail, dining, and entertainment options. La Cantera at Cinco Ranch, located in Katy, Texas, is a prime example, featuring an open-air shopping center that attracts both local residents and visitors. The acquisition aligns with Brimor's clustering strategy, which focuses on concentrating investments in specific markets to maximize operational efficiencies and create synergies among its properties. By doing so, Brimor aims to generate incremental demand and enhance the vibrancy of its retail locations. Brimor Property Group's acquisition of La Cantera at Cinco Ranch is also reflective of a broader confidence in the retail sector's recovery post-pandemic. Investors are increasingly seeking properties that can offer experiential components and cater to shifting consumer preferences for convenience and variety. This acquisition highlights a larger trend in the commercial real estate market, where investors are keen on properties that can adapt to changing consumer behaviors. With a focus on creating dynamic, multi-use spaces, retail properties like La Cantera at Cinco Ranch are well-positioned to thrive in the evolving landscape. Two prominent office buildings in Norwalk, Connecticut, are being considered for conversion into apartments, according to a recent report by commercial real estate broker Choice Peterson. The buildings, known as 101 Merritt 7 and 201 Merritt 7, are part of the Merritt 7 corporate park. As of a mid-year report, these buildings are no longer available for lease, raising questions about their future use. The office park's owner is contemplating transforming the two office buildings into residential spaces, as confirmed by Brian Baker, principal planner in Norwalk's Planning and Zoning Department. Although discussions are in progress, no official plans have been submitted to the city. The Merritt 7 corporate park was originally developed in phases starting in 1980 by Albert Phelps, during a period when suburban office developments were thriving in Connecticut. This potential conversion is part of a broader trend where office spaces are being repurposed due to changing market demands. In Lower Fairfield County, the office market is becoming increasingly complex. Some buildings are being auctioned for sale, others are being withdrawn from the market for adaptive reuse, and yet others are being reintroduced to the market after being previously taken off. In July, Connecticut Governor Ned Lamont signed new legislation to make it easier for owners of commercial properties to convert them into residential use. This legislative change is aimed at addressing high demand for housing and the evolving needs of commercial real estate. The move towards residential conversion is also evident in other locations, such as the former Common Fund building in Wilton and the former Pitney Bowes headquarters in Stamford's South End. Norwalk has experienced a significant apartment boom over the past decade, with landlords able to command higher rents. The Merit 7 Corporate Park's location near the Metro North commuter rail corridor makes it an attractive site for residential development. The state has invested in infrastructure improvements, including a pedestrian bridge linking the complex to a new Metro North station, further enhancing its appeal for residential conversion. The investors in Merit 7 Venture LLC, which owns the office park, include Albert D. Phelps Inc. and the New York State Teachers Retirement System. As the real estate landscape shifts, these investors, along with others, are considering how best to leverage their assets in a changing market environment. Apollo Commercial Real Estate Finance, known by its ticker symbol ARI, has long been recognized as a resilient player in the commercial real estate finance sector. The company leverages its expertise in structured lending and real estate investment trust compliance to navigate macroeconomic shifts effectively. However, its second quarter, 2025 earnings report presents a nuanced picture. While revenue fell short of expectations, distributable earnings fully covered the 10.2% yield dividend, and its capital structure remains conservatively managed. For income-focused investors, a crucial question arises. Does ARI's balance sheet resilience and disciplined capital deployment align with the demands of a high-interest rate environment? And does its dividend sustainability justify the risk? In the second quarter, ARI reported revenue of $43.1 million, which was below the projected $47.4 million. This shortfall was primarily due to adjustments for non-recurring costs and stock option expenses. Yet, distributable earnings, a non-GAAP measure critical for real estate investment trust compliance, rose to 26 cents per share, exceeding the 24.85 cents consensus. This divergence underscores the importance of understanding the metrics that drive real estate investment trust performance. While revenue misses can signal operational headwinds, distributable earnings reflect cash flow generation, which ultimately funds dividends. The key to ARI's performance lies in its capital deployment strategy. During the second quarter, the company committed $1.4 billion in new floating-rate first mortgages, with a weighted average unlevered yield of 8.1% and a conservative 57% loan-to-value ratio. These loans are spread across a diversified portfolio, comprising 25% residential, 23% office, and 16% hotel properties, with 36% exposure to the United Kingdom and 17% in New York City. Such diversification mitigates sector-specific risks and ensures steady income streams. ARI's balance sheet remains a cornerstone of its appeal. As of the second quarter, the company held $208 million in liquidity, including $182 million in cash, and reported a total common equity book value of $1.7 billion. Its debt structure is heavily secured, with 63% secured debt arrangements across 8 counterparties and a weighted average advance rate of 73%. Notably, ARI has no corporate debt maturities until June 2029, insulating it from near-term refinancing pressures, a critical advantage in a high-rate environment. The company also effectively manages foreign exchange risk, a growing concern for its international operations. By hedging through forward currency contracts, ARI recorded a $71 million net gain on equity from foreign exchange changes in the second quarter, offset by a $72 million loss on contracts. This near-perfect hedging strategy demonstrates operational discipline and protects cash flows from volatility. As a real estate investment trust, ARI is legally obligated to distribute at least 90% of its taxable income. Its second quarter distributable earnings fully covered the 25 cents per share dividend, up from 96% coverage in the first quarter. This improvement is a positive signal for dividend sustainability, especially as interest rates remain elevated. With a book value per share of $12.59 and a current stock price of $9.84, reflecting a 24% discount to net asset value. The high yield of 10.2% appears supported by tangible earnings rather than aggressive accounting. However, investors should remain cautious. While ARI's conservative leverage and liquidity position are strengths, the revenue shortfall in the second quarter raises questions about its ability to maintain growth. The company's focus on floating rate loans, though prudent in a rising rate environment, may also limit upside in a future rate-cutting cycle. For income-focused investors, ARI offers a compelling combination of high yield and structural resilience. Its real estate investment trust status ensures tax efficiency, while its diversified loan portfolio and hedging strategies reduce volatility. The absence of near-term debt maturities and robust liquidity further bolster its ability to weather economic downturns. Yet, the company's recent revenue performance, falling short of expectations despite strong distributable earnings, suggests potential challenges in scaling its operations. Investors should monitor ARI's ability to maintain loan origination momentum and ensure that distributable earnings remain aligned with dividend payouts. Apollo Commercial Real Estate Finance's second quarter results highlight its ability to adapt to a high-interest rate environment through disciplined capital deployment and conservative balance sheet management. While revenue discrepancies warrant scrutiny, the company's strong distributable earnings, 10.2% yield, and robust liquidity position make it an attractive option for income investors seeking stability. However, long-term appeal will depend on ARI's capacity to sustain growth in loan origination and maintain its current dividend coverage ratio. In a market where real estate investment trusts often trade at significant discounts to net asset value, ARI's current valuation offers a margin of safety, but not without its caveats. CBRE, the renowned real estate services giant, has adjusted its 2025 profit forecast upwards, anticipating a 20% earnings growth. This optimistic outlook is primarily driven by the increasing demand for commercial space, particularly office space, as reported by Aaron Elstein. The trend signifies a notable recovery in the commercial real estate sector, with office deals picking up pace. This resurgence in office space demand is a positive signal for the commercial real estate market, suggesting that businesses are looking to expand their footprints or return to physical office spaces post-pandemic. CBRE's forecast reflects confidence in the sector's recovery and highlights the ongoing transformation within the commercial real estate landscape. For those in the Kitchener-Waterloo and Cambridge, Ontario region, this news could resonate as the local market experiences similar dynamics. The demand for office space is showing signs of recovery, with businesses in the tech and innovation sectors leading the charge. This trend mirrors the broader North American market, where companies are redefining their real estate strategies to accommodate hybrid work models and collaborative environments. By drawing parallels between the Canadian and American markets, we can see cross-border relevance in these developments. As companies adapt to new work paradigms, the demand for flexible and modern office spaces is likely to grow. Investors and developers in both regions should take note of these trends, which could offer opportunities for strategic investments and portfolio diversification. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.